The second quarter of 2019 was an unusual one. Despite a sell-off in May, the quarter ended with Wall Street reaching new all-time highs, pulling the MSCI World Index of Developed Markets also to new highs. The most dramatic moves were in bonds, where interest rate expectations have been repriced substantially lower in the face of weakening growth, falling inflation, and rising deflationary fears. Yields on 10-year treasuries fell by 40 basis points in quarter two to 2%, taking the fall in yield to 70 basis points this year, and other government bond markets followed suit. In many major countries, yields have fallen to all-time lows. In Germany, 10-year yields are minus 40 basis points, for the first time ever dropping below the ECB's deposit rate, with positive yields available only on maturities above 20 years. These are extraordinary moves given how low rates already were at the beginning of the year and have resulted in exceptional performance from bonds. Global government bonds returned 3.4% in sterling terms for quarter two and 5.7% year to date, while in credit, corporate, high yield and emerging market bonds all produced good returns in quarter two and of 10% or more so far this year. The UK gilt market also rallied with a return of 1.4% for the quarter in sterling terms. The UK 10-year gilt yield of about 0.8% may not sound like much, but now there is over $13 trillion of bonds trading at negative yields worldwide. For the quarter, the US and world markets returned 4%, taking year-to-date returns to 18% and 17% respectively. The UK equity market returned 3% in sterling terms. In remarkably benign conditions with nearly all asset classes up, it was notable that safe haven assets also performed well, with gold up nearly 12% in sterling terms in quarter two and the Japanese yen up by nearly 6% against sterling. In part, this might reflect the growing uncertainty about the state of the global economy and geopolitics, and in part the longer-term implications of the truly extraordinary conditions in bond markets. President Trump continues to provide noise and unpredictability, but it was unquestionably the shift to much more dovish positions by the Fed and the ECB which was the driving force behind markets. Central banks are reacting to two critical developments. First, increasing evidence of a slowdown in growth, and second, a fall in inflation and perhaps more importantly, inflation expectations. The slowdown in growth to date has been largely in manufacturing, with global trade hit by the US-China trade war and the key auto industry facing unprecedented disruption and falling sales. Manufacturing is in recession in Europe and slowing sharply elsewhere, and leading indicators point to a continuing tough environment. To date, the consumer and service sectors have held up well, but there have been signs recently that confidence is waning, increasing worries that a soft patch triggered by the downturn in manufacturing could become more widespread. The drop in inflation highlights the problems that central banks face. After a decade of ultra-loose policy, inflation in most developed countries remains below central bank target rates. Indeed, inflation in the US, Europe and Japan has remained stubbornly below target rates throughout the post-crisis period, despite the efforts of central banks to push it higher with unprecedented monetary largesse, and the spectre of deflation remains a worry in the Eurozone and Japan. Despite the strong returns this year and the powerful support to valuations from low inflation and exceptionally low interest rates, uncertainty remains high. Aside from the slowdown in growth, the unfolding trade wars and the negative impact on corporate earnings, other concerns, each with the potential to damage confidence and growth and to disrupt markets, continue to worry investors. Some caution is then warranted in the short term. Equity and bond markets have risen sharply this year, driven by the prospect of easier financial conditions, and valuations have become stretched in some areas, notably in fixed income. Yet the economic backdrop has deteriorated a little, corporate earnings are under pressure, especially in sectors most exposed to manufacturing, and markets are largely discounting sizable policy easing by central banks in coming months. However, while trade and manufacturing have been weak, the key service sector has remained firm, employment has been strong, and the consumer is generally in good shape. There are no signs of systemic financial problems and an ensuing liquidity crunch, or of capacity shortages, inflation, and a sudden tightening of policy. With inflation subdued, central banks have considerable flexibility in keeping policy ultra loose for much longer, thereby extending this extraordinary cycle. Furthermore, the extent of the falls in the government bond yields and the impact on financial conditions and valuations of other markets should not be underestimated. US bond yields have fallen by over 100 basis points since late 2018. This provides a strong underpinning to equities and other risk assets, offsetting the more challenging conditions faced by the corporate sector after last year's benign backdrop. While some consolidation is probably overdue, we do believe the cycle has further to run, and any falls in markets will give rise to opportunities to add to risk assets, while at all times maintaining careful diversification in portfolios to provide protection during inevitable short-term setbacks.
The IPlus portfolios posted positive returns over the first quarter, ranging from 1.3% for IPlus 3 to 4.1% for IPlus 6, which were comfortably ahead of the short-term inflation plus prints. Returns were positive across most asset classes over the quarter, led by higher equities, where regional returns ranged from marginally negative in Japan in local terms to positive 5.7% in Asia ex-Japan. UK equities returned 3.3%. Bonds were higher across the board with positive returns from both rates and credit, with prices buoyed by the prospects of looser monetary policy. All of the portfolios outperformed their relevant strategic asset allocations, and this is a pleasing outcome as some managers struggle to keep up with the strong market rally. This is to be expected from our manager blend though, and it was notable that value strategies continued to underperform. That's somewhat offset by strong performance in the growth part of the portfolio. Within fixed income, bonds rallied hard, but the allocation effect from bonds was negligible this quarter. If there was some underperformance, it came mostly from the underweight in linkers, but in strategies that have an inflation plus objective, it is difficult to invest in a strongly negative yielding index-linked gilt. US tips on a hedge basis are more attractive. The exposure to gold was strongly accretive to performance in the quarter as the yellow metal benefited from the compression in real rates. With gold being up 9% in quarter two, absolute contribution was around 50 basis points at the fund level. For the 12-month period, the IPlus portfolio's performance ranged from around flat for IPlus 3 to positive 4.5% for IPlus 6. Our equity allocation remains broadly in line with the strategic asset allocation. Within equities, we continue to have a modest allocation to emerging markets and retain the UK bias via managers such as Evenlow, Lindsell Train, Schroders and RWC. In recent months, we have largely left the equity weight intact as markets have continued their upward trend, and that's after increasing risk through the first half of the year. Within fixed income, we remain underweight, but we have added two new strategies, the 24 Income Fund, which is an ABS strategy, and the Sequoia Infrastructure Debt Fund. Both of these are floating rate strategies, but both clip a healthy yield in these more specialist markets. We maintain an allocation to a blend of alternative strategies, which aim to achieve mid to high single-digit returns over a cycle and diversify the portfolio at a time when bonds are at their most expensive. Within that allocation, we sold down the F&C and Aberdeen strategies in the second quarter and reallocated part of the proceeds to the Neuberger Berman Uncorrelated Strategies Fund, which is a more balanced blend of alternative risk premium. We also continue to hold around 5% in gold to provide diversification, and we've been fortunate to have gained from this as markets have risen with the compression in real yields.